Hello dear student, I am Suchibrata Seleng, your teacher for Business Studies subject. This is second tutorial on financial management. Let's have a recap of our tutorial 1. In the earlier tutorial, you have learned the meaning of business finance. You have learned the need of finance in business firms. You have also learned the meaning of financial management. Now in this tutorial, you are going to learn the importance of financial management and the objectives of financial management. Let's first discuss the importance of financial management. In your earlier tutorial, you have learned that financial management is mainly concerned with proper management of sourcing of fund, proper investment of fund, and proper distribution of the profit or the return earned by the business firm. That financial management directly influence the financial position and financial health of a business firm. Now, when financial position is said, it is the statement of the assets and liability. That is the balance sheet. It shows the financial position of a business firm. Now, when the asset structure is growing and ownership capital is strengthening, the business firm position also strengthen. Again, financial health, it is reflected in the position of liquidity, profitability, ability to face financial risk, and many other related aspects. Now, what is liquidity? Liquidity is the ability to pay current liabilities. That is the short-term solvency of a business firm. Profitability, it is the ability to earn profit. Now this is related to sales of the organization and also the investment made by the organization. Financial risk is a possibility that the firm may face trouble because of inappropriate capital structure. Generally, in a capital structure, you will find a mix of ownership capital and borrowed capital. Now, for a business firm, borrowed fund is a preferable source in terms of the cost of capital and in some other benefit like tax benefit. Now, this benefit they can reap only when their return on investment, that is ROI, return on investment is more than rate of interest. Now you know rate of interest, it remain fixed, that is the debt charges remain fixed, and because of that if return on investment goes on increasing, then the firm owner can retain more benefit for them, means the earning per share increases. Now, as I said, the condition must be fulfilled that return on investment is more than your rate of interest. And if that condition is not fulfilled, then the firm may face into trouble. So that is financial risk. Now, a healthy sign of a business firm is that they are able to face such financial risk. Now, how the fund is managed is going to influence many things. Some of the things of the business firm are the size and the composition of fixed assets, the quantum of current assets and its composition, proportion of long-term fund and short-term fund to be used in the organization, composition of ownership capital and borrowed capital in the capital structure. All items in the profit and loss account such as interest, expenses, depreciation, etc. are also influenced by financial management. It means all items in the financial statements, profit and loss account, balance sheet, of a business, that is, their financial health and financial position, are affected directly or indirectly through financial management. And there lies the importance of financial management. Now, we'll discuss the objectives of financial management. The primary objective is to maximize shareholders' wealth. It means maximization of the market value of equity shares. So, it is also called wealth maximization. Now, the firm can make it happen only when the finance is managed properly. The current value or the market value of shares will increase only when each of the financial decision taken in the firm reap more benefit than cost. That means if you do a cost benefit analysis, then the benefit of the decision should be more than cost. That is, the value addition may lead to increased market value of shares. So that is wealth maximization. Now the related objectives of financial management are to maintain liquidity in the business firm. So as we already discussed, liquidity is the ability to pay current liabilities of the business firm. Profitability, it is the ability to earn profit or return for the business organization. Avoiding financial risk. So this also we have discussed, that if the capital structure is appropriate to the business organization, then they can avoid financial risk or they can manage financial risk. Cost control is another objective of financial management. Now that cost need to be controlled while sourcing the fund, because in sourcing of fund also cost is associated. What you call cost of capital is associated. Then in case of investment also cost can be controlled. It's because whatever the investment made by the business firm in various assets, they need to do a cost benefit analysis, and after that where the benefit is more, that asset should be chosen for a business firm. That may lead to cost control. Now all these objectives of financial management are achieved only when some value addition takes place from every financial decision taken in the firm. So in our next tutorial, we will discuss the financial decision. With this, we are concluding today's session. Thank you.